Greetings, it is time for our monthly quantitative easing monetary creation update, and whether that is in fact causing aberrantly high inflation or not. Longtime viewers are familiar with this monthly report, but every month we have a bunch of new viewers as well. So there is some repetition for longtime viewers, but new viewers should watch the entirety of this video to understand the connection between monetary creation, also known as quantitative easing or informally as money printing, and whether it creates inflation or not, and if it doesn't, where does that monetary creation go? And I say it is offset by technological deflation, and this equation is very robust and has enabled me to make many years of consistent predictions on how monetary creation has to be permanent and exponentially rising. This is contrary to all the established PhD economists and what they think, as well as the central banks of the world, which are of course also run by PhD economists, and how they continue to get things wrong and are about to make another mistake yet again. And we'll talk about that as well. So we go to this monthly Yardeni report produced by Dr. Ed Yardeni, and this is his phone number and email if you want to contact him. I'm very glad that they produced this report and post it for free and update it almost daily. This is an invaluable resource with which to realize what worldwide quantitative easing is, because the worldwide number is the only one that matters. What the U.S. Federal Reserve does is not all that important, and the notion that the U.S. Federal Reserve printing money will cause a worldwide asset like gold to go up is absurd, as I will explain. So we scroll down as we do each month. These are the four major central banks of the world: the United States, Europe, Japan, and China. They comprise about 90% of all the world's quantitative easing money printing. Not all of it, but about 90% of it. The remaining 10% is done by a number of smaller central banks. And the red line is the United States Federal Reserve. And as you can see, it is not even the largest contributor of money printing over the last 12 years. It's the second largest. And ultimately, it's only done about 25% of the total. Now, only this worldwide number in total matters. And for that reason, we go to the next chart. This is the sum of the four lines that you see above. So the sum of these four up here is what you see here. And you notice that the grand total is about 30.8 trillion, and the US Federal Reserve has done only 8.6 out of 30.8, so a little more than 1/4. Again, Europe has done the most at 9.6 trillion. And you can see how this is an exponential rising curve, and every time they try to reduce the amount of QE, something happens in the market and they're forced to print more. And COVID-19 just shook loose some of the market forces that were going to happen anyway. Even if we never had a COVID-19 crisis, things would be around here nonetheless, just through a slightly different path. But what is important is that this is an exponentially rising curve. That is because the amount of technology in the economy is now becoming a significant enough percentage of the total economy that it generates enough deflation that this money printing has to be done just to offset that deflation and maintain a baseline, moderate, optimized level of inflation of about 2 to 3% a year. So this is the grand total, and it's rising exponentially, and this curve will continue to occur, and it should be obvious to people by now. I wrote a publication that was published in early 2016 saying all this. I had a lot less data to go off of at that time than I do now, and what I have predicted in there has continued to come true, as all sorts of commenters can attest to. But what's important is what the gradient is over here. What is the annual growth rate? And for that, they have a chart right below this. So now the year-over-year growth rate, as you can see, is down to just 10.6%. That is pretty low. That is not high relative to any point in the last 12 years. That is also below my published band of an optimal amount of world QE, which is 16 to 24% a year. 16 to 24% a year is the optimal band. Above that band for a long time will in fact cause inflation, but going below that band is insufficient, and the markets will correct in order to force the central banks to print more money. Way back in February of 2021, we reached a gigantic 46.6% year-over-year amount of QE, and that really probed the ceiling of where inflation might occur. And the small amount of inflation we've seen for a couple months is perhaps some byproduct of this. But as this growth rate has ramped down, we know that that inflation will be very, very transitory, as I will also discuss later in this video. Now we're down to just 10.6% year over year. That is pretty low. Now to get back to even 16% 1 year from now, So they're reading 1 year from now to get back to 16%, meaning 16% increase in cumulative quantitative easing relative to today over the next 12 months requires another $5 trillion of money printing. So going back to the chart above, 30.8 will have to become 35.8 or 36 or something like that to get back to around 16% year-over-year growth. We have to do 400 billion a month just to stay in place. And the fact that they're ramping it down is the wrong thing to do. It will cause the markets to correct. The stock market and housing will both go down. We will be on the brink of recession. There will not be inflation anymore, and yet they will have to do quantitative easing again and again. They have tried to stop quantitative easing in the US at least about 4 times already, and all 4 times they were forced to do more than they were ever doing before. Somehow, this is not causing them to question their models because, remember, PhD economists are extremely theoretical people. They are never held to account. And when reality does not match with the models that they have memorized from 1950s era textbooks, then they just ignore reality. And why not? The only people who can call them to account are people outside the establishment like me who don't have a big enough audience yet. But the fact remains, by ramping down quantitative easing, they are going to cause a correction, and they're going to have to do more than ever before. And despite all the talk of the tapering that the Federal Reserve is doing, and I'll get to that in this video, I guarantee that 2 years from now, they're going to be doing more quantitative easing than before, and the Fed funds rate will again still be 0. And I'll talk about that in detail. But this growth rate is extremely revealing in terms of where quantitative easing should be, and it may seem like a large number. 400 billion a month is the minimum that has to be done just to stay in place. Remember, in 2011, to maintain this growth rate, it was only 75 billion a month, and inflation started to appear at even 75 billion a month, but now even 400 billion a month cannot create in 2021 and 22 what 75 billion a month was able to create back in 2011, because technology is so much of a larger portion of the economy, and technological deflation is becoming a bigger and bigger feature of the entire economy. Now, as we scroll down, now this is a chart that completely destroys all these people who say that the Federal Reserve printing money is going to cause inflation, or even worse, already has caused hyperinflation. But the other people who at least have the sense to say that we are not yet in hyperinflation, it just could happen, they still don't know what's going on, and this is the chart that proves it. Because this is the chart of cumulative quantitative easing relative to annual GDP of each of the 4 central banks. Now, yes, cumulative quantitative easing is not an annual metric, and GDP is an annual metric, but at least it's equal for all 4. As you can see, the US is just about the lowest of the 4. Just as low as China. It's the lowest of the 4 in terms of amount of quantitative easing done. Europe, the people who are supposedly the most afraid of inflation, they have done twice as much as the US. The European Central Bank has done twice as much QE in proportion to the size of its economy as the US. And who has done the most? Japan. They have done more than 4 times as much quantitative easing as the US has done. And even the people who claim that the US has unusually high inflation at the moment, none of them are claiming that Japan has high inflation. That's why if these people cannot explain how Japan can print so much money and still not have any inflation, they still are teetering on the edge of deflation, such a person just does not know what's going on. Now, I have explained how this can be true because printing is worldwide and borderless. Only the world's grand total matters. Japan can do 4 times as much in relation to the size of its economy as the US does, but since it just goes into the worldwide pool, Japanese QE offsets US technological deflation, and therefore the world total, which we saw above, is the only one that matters. If the US were to completely start reversing its QE and other central banks were to print exactly that much and the world total was compensated as a result, then also it would break the models of all these PhD economists and the people that listen to them just because they don't understand the worldwide connectedness of all this. Technology is worldwide, technological deflation is worldwide, and therefore monetary creation is worldwide. So to say that the US Federal Reserve printing money is going to cause gold to go up, when in fact the printing of money has been going on for 11 years anyway, and the US is just one country that does 25% of the world printing, there are just so many levels of cluelessness and ignorance in a sentence like that that it just really boggles the mind. Now, since the Federal Reserve is hell-bent on tapering, hopefully they don't clamp down the world total too much, because this is the S&P 500 in relation to the amount of world quantitative easing. Yes, the US Federal Reserve wants to clamp down tapering aggressively, but that really doesn't do a whole lot for the world's total. Nonetheless, by not keeping up with the gradient, the second derivative that requires 16% a year or so just to stay in place, the US Federal Reserve is going to cause a stock market correction. It's going to be at some point within the February to August timeframe. And as we get closer, we'll see if we can get more precision in that. But there's going to be a big correction in the February to August timeframe unless another country prints more money to offset the deprinting that the US is very misguidedly doing. So why is the US Federal Reserve talking about a taper? Well, let's look at what exactly they intend to do. This is a CNBC article, and they say that the Fed will aggressively dial back its bond buying and sees 3 rate hikes next year. Now, every time they try and hike rates, they are forced to quickly reverse it. And I have said years ago, more than 6 years ago, I said the Fed funds rate is going to be zero pretty much forever. Any small increase they do has to be quickly reversed, and that has continued to occur. But they just can't learn because they are still in a 1950s model, which was a pre-technology economy in terms of technological deflation. So the Federal Reserve is not only going to reduce its quantitative easing by 30 billion each month, in that it was 120 billion per month in November, which just ended, but now it's going to be 90, 60, 30, and 0, and pretty much done by April, as they're saying. And then they will start to raise rates, and they think they will do 3 rate hikes next year. They have learned nothing. This is the 5th time they're going to try the same thing of thinking that a Fed funds rate of 2.5% or 3% is normal. And the word they actually use is normal. They talk about normalizing interest rates. They have a dot plot in which all the Fed governors vote on what they think the long-term Fed funds rate is going to be, and they all are completely wrong, and I discussed that in this video up here. They all think it's 2.5 to 3%, and almost none think it can be zero forever because they think that 3% or 2.5% is normal. Why they think that? Because they don't understand technology, they're not curious about anything, they're not held to account, and a PhD economist is, in relation to the real financial world, what someone who reads about doing surgery is to a real surgeon. And even that is being generous to the PhD economist. They are super theoretical people. They don't understand what a prediction is. They think that talking about the past is the same as making a prediction. And I discussed that in this video up here, where a very well-known economist talks about the past and thinks he's making a prediction. And there's nothing specific to him at all. He's just doing what all economists do. They have no concept of what a prediction is. So the Federal Reserve thinks they're going to be able to pull this off. Luckily, I am creating these videos that archive all of this. They will, for the 5th time, be embarrassed and will be forced to reverse. And I guarantee that 2 years from now, the world will be doing much more QE than it is doing now. And among the world, the US will also be doing more than it is doing now, contrary to the dot plot forecasts that these Federal Reserve governors and all the PhD economist theoreticians who surround them say. They have no understanding of technology. They have no curiosity about the economics of technology. And they are far more afraid of inflation and far too unafraid of deflation than they should be because they know nothing about the real economy. Now, it sounds funny for me to say that people with PhDs in economics from the best schools know nothing about their own field, but historically that has happened many times before. In 1901, as late as 1901, the establishment in mechanical engineering was certain that heavier than air flying machines were not possible because they'd all memorized the same textbooks. Then someone actually went out and produced the machine, and these people said, oh, after the fact, sure, that makes sense. But they were never, ever willing to own up to how their orthodoxy simply had siloed all their knowledge and forced them to memorize outdated information. And they created an incentive structure within their own profession where young people could advance in their careers only by memorizing the outdated information. And that is what's happening here in economics as well. And I talk about that a lot on this channel. But why are they acting this way? Because a couple of months have an inflation reading that they think is high, but even that is wrong. They're reacting to the imaginary notion of inflation when, in fact, there is not any aberrantly high inflation as per what you should really look at, which is commodity prices, but even as per their own CPI index. Now, what is the most recent inflation rate? Tune out all the noise that comes out from the media, because the media has to not only fill a volume of time every day, but the media makes money by making you angry or frightened, and therefore the media has an incentive to pretend that inflation is much worse than it actually is. And the media doesn't know enough about why deflation is bad. Otherwise, they would scare you about deflation as well, but they don't know enough about that because they've only memorized what these PhD economists have compressed into sound bites for them, which the media can take and run with. So what is inflation actually at? For that, we go to part 2 of this video. Now, as you know, I have created a methodology to measure inflation using long-term moving averages, and therefore it's a far more robust and comprehensive measure. The measure that I use, which I describe in this video up here, which you see in the tag to the right-hand side, is that for inflation to start to be a little problematic, meaning that worldwide quantitative easing, monetary creation, should be paused until the numbers go below this threshold, is when the US CPI 10-year compounded annual growth rate is above 3% a year, and the Goldman Sachs Commodity Index is also above 3% a year as a 10-year moving average. We use 10 years as a window on which to calculate the compound annual growth rate, because using too small of a window is the primary trick that the media uses to say that inflation is super high. They're starting from very convenient starting points to create something narrative worthy out of what really is just statistical noise. So let us see what inflation really is today, December 11th, 2021. I used the US date convention, but today is December 11th, 2021. And let us look at what both of these metrics are based on the official websites for each. So we go to the US Bureau of Labor Statistics, bls.gov, and down to Consumer Price Index, and click on this little graph icon. And we go over here into more formatting options, and we choose 1 month, 3 month, 6 month, and 12 month, as well as original data value, which will enable us to calculate the compound annual growth rate and retrieve data. So this is the original data value. It seems to be ticking up, but is that really above trend? Is that a worthwhile incremental increase relative to this long-term trend line? And remember, this is supposed to be exponential, not linear. So this is how we calculate the 10-year compound annual growth rate like we have in prior months. We take this most recent reading of the CPI, about 279, relative to the one exactly 10 years ago, which is about 227. And so I take 279 divided by 227. 1.229 is the answer over here. So almost 23% inflation over 10 years. 23% inflation over 10 years. And we take the 1/10 root of that, which is x to the y, 0.1. 1/10 root of a 10-year growth rate will give you the compound annual growth rate averaged over those 10 years. And we have 2.08% as the compound annual growth rate. 2.08%, call it even 2.1, round it up. 2.1% is the growth rate of US CPI over the last 10 years. That is 1 decimal point higher than last month and 2 decimal points higher than 2 months ago. So it has in fact increased from 1.9% to 2.1%. That is very low. That is still within statistical noise. It is certainly not close to 3%, and it will take a long time to even get to 3%, even at the current rate of increase, which itself will dissipate. I'm very, very confident that by April, May, June or so, this CPI number will moderate back down, and a lot of people who are screaming now will either not be found or will cling to their hyperinflation narrative by doubling down and getting even more out of control. Like, for example, that Economics Explained channel, which I debunk in this video over here, is one that says we're already in hyperinflation, and he's been saying that for about a year now. And when hyperinflation doesn't show up in the indicators, he proceeds to say the introduction of expensive luxury items proves that there's more hyperinflation. Now, that is crazy. So higher end products being introduced means that there is inflation, hyperinflation even. And remember, the definition of hyperinflation is 50% a month, not a year, 50% a month. And we are still at 2.1% a year. That's not even at the optimal level yet. It's below the optimal level. But now, as you can see, this is the 1 month data, and all the media screeching here about is about this general increase over here. But if you look at the 3 month data, well, okay, it's no longer at the high of several months ago. At the 6 month data, it's plateauing. It's higher than before, it's plateauing. And then this is the 1 year data. Yeah, it's higher now, but what about offsetting when it was close to zero over here due to COVID-19 in 2020 and also over here in 2015? That's why the average still is 2.1%. That average that we just calculated, 2.1%, is in fact what you would see as the average of this line if you were to plot a trend line along all this trailing 12-month CPI data. The media is only reporting the trailing 12-month amount, and it happens to be high right now, but that's because it's recovering from this unusually low period. Now here's the other problem. The US CPI is for the US only, and as I explained elsewhere on this channel, all money printing is worldwide. And therefore you should only look at worldwide metrics, and you should look at commodity prices because commodity prices are the purest measure of inflation. Anything related to services is part of inflation, but it is not as clear that that is harming people if it gets high in price, because that also comprises people's wages. Service prices rising is simultaneous with wages of the service provider rising, and therefore there's a lot more nuance that has to be in that type of discussion, including what is the productivity growth rate of those services or not. Those details are needed before one can say that service price increases are in fact inflationary and are much less lowering standards of living of people. So now we go to the next metric, which is the Goldman Sachs Commodity Index. Goldman Sachs Commodity Index, and this will be in the description box below. Over the last 1 year, it's risen almost 40%. Yes, but was that the right starting point? And this is why a 1 year snapshot is not very revealing. You have to go to a 10-year snapshot. Sure, it rose 40% from this unusually depressed point because of COVID-19, but over a 10-year basis, it is in deflation. The average annual growth rate is minus 1.76%. Minus 1.76%. That is deflation. Commodity prices have been in deflation over the last 10 years, and not just for a short while or because of some sudden price fall or anything like that. Deflation over 10 years. How can we talk about hyperinflation occurring when this, which is not riggable because these are the actual traded prices of commodities, oil, gold, natural gas, and others, and it's worldwide? All the people who say the Federal Reserve's money printing is causing gold to go up, which is not, gold is in fact not going up, they are conflating the central bank of one country, the United States, which is only 25% of the world's printing, with a commodity that's priced worldwide. So a lot of otherwise intelligent people are doing this type of very, very amateur mistake and are pretty much incapable of thinking clearly because all of their narrative around inflation is just completely emotional. The fact is, commodity prices have been falling. They're in deflation, minus 1.76%. So now we go back to my PowerPoint. So the US CPI 10-year compound annual growth rate, Goldman Sachs Commodity Index 10-year compound annual growth rate, and as we saw, the US CPI is only at 2.1%, and the Goldman Sachs Commodity Index is at minus 1.76%. Now, the Goldman Sachs Commodity Index is lower than last month, and the US CPI is a little bit higher, and that is a quantification of government mismanagement. We are starting to create a metric through which government mismanagement can have some degree of quantification, because the US CPI is creeping up even despite commodity prices getting lower and lower, and this can only be because of government mismanagement. Remember, I always say that government mismanagement can ruin almost anything, and it can in fact mess up the nice thing we have going on right now, which is a monetization of technological deflation, and it can throw some sand into the gears over there. So hopefully government mismanagement is something that the market punishes and forces better competence out of. We shall see. But the fact remains, neither of these two are anywhere close to 3%. And again, not that 3% would even be a crisis. That's just when the amount of QE done should pause briefly until these metrics dip a little bit below 3% again. So this is where we are right now. All the inflation narrative that you hear about in the media is completely false. People talk about inflation because they're desperate to seem intelligent about this subject. It's ridiculous. I should do videos about how perception and reality are so far apart on this inflation metric because of the innate need for people to feel intelligent when they really don't understand a subject, combined with the media's financial incentives of scaring people and making them feel like their future is bleak. It's really quite sad, and it's something people in the future will find particularly odd about our time, that everyone was convinced they were amidst hyperinflation when nothing of the sort was going on at all. Commodities priced worldwide are actually in deflation. But at the moment, there's absolutely nothing in terms of inflation that you need to worry about, and there's no reason for the Federal Reserve to even start tapering at all. In fact, tapering is going to cause a problem. It's going to cause a major market correction, a housing price decline, and they'll be forced to do more money printing than ever before. That's what happened the last 4 times they tried to stop quantitative easing, and that's going to happen this 5th time as well. All of this is going to unfold in coming months. Now, if you like this type of content and you found this video informative, I encourage you to subscribe to this channel, and thank you very much for watching.